All right, so basically, you should have gotten for McDonald's a G of approximately 1.1%, depending what ROIC you used, an ROIC of approximately 21%, again, depending on which part of the range you were in, and a WACC of 6.5. Okay? So margin for McDonald's about 30.7. Margin for Chipotle around 18.8. G, I got 5.83, given an ROIC of 37.5. So again, slightly changed ROICs might get you slightly different Gs, but you should be in that range. Close to 6% G for Chipotle, close to 1% G for McDonald's. All right. Any other questions about any of these numbers? This is, by the way, being recorded. Okay. So the idea here is that using the key value driver formula, we basically solve for the G, given the margin, the ROIC, the WACC, the tax rate, and the actual EV to EBIT. Specifically, EV to EBIT is these other factors. Now, when I go back to, I added an additional column called spread. Because if you go back to the Walmart example, if we go back to the Walmart example, one of the assumptions we often make when we do multiple analysis is all the companies have a similar WACC. But if you remember when we talked about Family Dollar had weird multiples because their WACC was an outlier, right? So to be honest with you, it's not just growth in ROIC, it's really growth in spread. So you'll probably get an easier explanation if you actually do growth in spread versus growth in ROIC. So since we have all of the data, what I did is I just created something called spread, which is just the difference between the ROIC and the WACC. Okay? Now this weighted average, I actually calculated a weighted average because the weighted average I exported wouldn't work for a G and a spread. So I did it based on the market cap here. So I summed the market cap of Chipotle and McDonald's, took the percentage of the market cap for Chipotle, multiplied by their G to get, and then take the same for McDonald's, take their percentage of the market cap to get a weighted average. That's more than I asked you to do for this assignment, but I just want to let you know where that weighted average is coming from. So again, really with this data here, I'm trying to explain these multiples up here. All right? So again, back to the extra credit potential. Does anybody want to try and do that first? Nobody wants the extra credit point? You're willing to try it? Explain what? You're trying to explain, you're doing the multiple analysis as if this were the project. You're explaining these multiples using this data. Why higher or lower? You ready to give it a shot? Sure. Did your numbers on your spreadsheet look similar to this? Yeah. Did you work with a partner? No. Did you do it by yourself? Yeah. Okay. So email me your spreadsheet, not right now, but before you leave today, email me your spreadsheet and obviously your name attached so I can give you the extra credit. But come on up to the front of the room and you can drive the computer. So thank you for being able to do that. We just need to email you this. You're uploading that as an assignment. All right, let's pay him some attention since he's being brave and willing to give this a shot.
All right, so first for the EV to EBIT, the difference lies in the fact that Chipotle has a much larger G and much higher ROIC than McDonald's, but it's offset a bit by how McDonald's has a lower WACC, but not enough. So this is why Chipotle's EBIT is EV to EBIT is higher than McDonald's, and the same thing for EBIT to EV to EBITDA. It's factored in before depreciation and amortization, so it's still relatively the same.
All right. Can we infer the same thing for the PE ratio?
Um, the PE is affected by their capital structure, and Chipotle is completely equity, so it's distorted compared to McDonald's, who has debt, but
Okay.
it's similar. The thing is similar.
Okay, so if I could just stop you right there, that's exactly the type of insights that I want you guys to connect. And I'm going to break down what he said even more simply. Because to be honest with you, the power of your presentation was already done when you did the math. Like the big what's in it for me is on rows 11, 12, and 13. So just going back to that, what I want you to start to associate is that look at those EV to EBITDAs, EBIT, and to some degree PE is much higher for Chipotle because they're getting both good growth and good spread compared to McDonald's. Because remember, growth is like that accelerant, it's the gasoline we're throwing on a fire. So they have a good spread and they're growing it exponentially faster. So therefore, they're becoming more and more valuable. Hence why they're getting 2 multiples and I'm paying a lot more for their earnings. Because they're getting more enterprise value as a result of that, and therefore more value. So it's really very clear that Chipotle is higher because of that very high growth rate of almost 6% and the higher spread of 29.3% spread, 37.5% ROIC. Just the other thing is when you're doing these presentations, refer to actual numbers. All right, notice how I'm actually saying because they had a growth of almost 6% or 5.83%, as opposed to saying because they had a higher growth rate. Just so that people know what magnitude and number you're talking about. All right, so that was great. How about linking the EV to sales?
The EV to sales, Chipotle has it's more similar than their EV to EBIT because Chipotle has a lower margin than McDonald's does, so it lowers it somewhat when multiplied by that, but Chipotle is still higher because its EV to EBIT is originally much higher.
Okay. Here's the thing. If a company has a higher EV to sales, what should be our bias? They should have better margins. Who has the higher EV to sales? Chipotle. But when we do the calculation, they have lower expected margins. Does everybody see that? So that doesn't make sense. Explain to me the price to book multiple.
So Chipotle is trading at 10, like their market price is 10 times their on book assets, and McDonald's is 6.8 times. So I would say that Chipotle has a much better spread than McDonald's, and that's why it's trading that way because investors.
Absolutely right,
Yeah.
and that's what we talked about. The price to book could be a clean view of the spread, unless it's distorted by the accounts, but it doesn't appear to be distorted here. So that's a clear reference between the two. Good linkage, right? This one's going to be tougher. Explain the price, the PEG ratio. Now, before you explain it, give me a definition of what should PEG tell us.
PEG,
PE divided by the growth.
Yeah.
What should it tell us?
It should tell us. It should tell us how much you're paying per growth.
That's right. And why would you pay more for the growth?
Because
you should have more spread and higher expected ROIC. All right, everybody clear on that? All right, so basically that's why I said the PEG should tell us about the expected ROIC. See if that does that with McDonald's and Chipotle.
So the PEG is lower for Chipotle than McDonald's, but Chipotle has a higher ROIC than McDonald's. I think that is supposed to be how it is. A lower PEG means that they have a higher ROIC.
No, a higher PEG would be a higher ROIC because I get a higher PE for the same growth because I have the higher expected ROIC, or something else is distorting it. The tax rates are similar. McDonald's is lower, but I would expect with the higher tax rate, I'd have a lower ROIC, yet Chipotle still has the higher ROIC. So something doesn't make sense about the EV to sales, and something doesn't make sense about this PEG ratio. That's actually why I chose this pairing for an in-class exercise. All right? So thank you for doing that, because this was actually a tough one. It was very clear for the other three, so thank you. As I said, when you send me an email with your spreadsheet, so I know to give you the extra credit, everybody else, make sure you upload it on the homework link for today before you leave. But here's the point. Chipotle and McDonald's are not good comparables. They're not good peers. All right? This is what I was trying to explain to you a few weeks ago. We went through the multiples lecture. All right? And here's the point. We put Chipotle and McDonald's because we're like, oh, they're both fast food, fast casual food. All right, maybe Chipotle's burritos and McDonald's burgers, but they're at least both fast food restaurants. But that wasn't what I told you. I said you want companies that have, sorry, this is being recorded, so if you can hold it down for a second. What you want is you want companies that have similar growths and similar ROICs. Right? What's the problem here? It's the growth. It's not the spreads, the growth. Particularly the growth. Spreads, yes, but growth in particular. Because you have Chipotle growing at almost 6%. Now this is perpetuity growth. And McDonald's 1%. Graph this in Excel. If you have a company with compound annual growth rate of 6%, you got somebody with 1%, you're going to see an exponential difference in growth and cash flow over the future time horizon, particularly when you get out into the out years. And that's what's happening here. That's why these multiples are not as comparable as they might think because of the distortion, because I've got a mature company, very mature company, McDonald's, with a very early stage, very fast growing company. Chipotle is 1/10 the size of McDonald's. So that's the point. Chipotle has a lot of growth ahead of it. McDonald's is basically flat. Apple and an orange. So this is the challenge that people struggle with when they do multiples. And here's what I mean by that. What most people would do, what the bankers would do, the academics would do, is they'd say, okay, I'm going to take an average of these two companies, and that's the average multiple for the industry. But it's really not, because you're taking an average of a mature company and an average of a fast-growing company, and you're saying that's the industry average, and that's really an apple and an orange. And that's one of the insights I wanted you to draw out of this, is that you can't really explain the PEG because the multiples are different. And you can't explain the EV to sales because the multiples are different. They don't give you the exact, because of the difference in growth rate, more than anything else. Now here's the thing. If they have the same growth rates, and then one had a bigger spread than the other, these multiples would make much more sense. But they don't because the growth distorts it. So that's what's important when you do your multiple selection. So it doesn't mean you can't put Chipotle as a peer of McDonald's. It just means you got to be careful when you do this, and you might even have a subtable. And you have the multiple of the mature peers, and you have the multiple of the growing peers. In fact, if I were doing Chipotle, who do you think I'd rather put in here than McDonald's? Panera. Or what's another one? What's the other burrito place? Qdoba. Like, give me a table that shows me Panera and Qdoba with Chipotle. Who would I want to compare McDonald's probably more closer to? Burger King, Wendy's, Yum, okay, which is Taco Bell and KFC. I think their growth rates are probably more similar and more mature. I think then you'll get a much more representative multiple analysis. So I just, and again, thanks for trying to do this. The EV to EBITDA is much more obvious. The EV to EBIT is much more obvious. The EV to the PE is obvious. Those other two ratios are a little bit weird just because what this is really telling us is Chipotle, which is still early stage, because remember, we're doing a day one perpetuity, which Chipotle's got this big period of growth before they become mature, and that's built into their multiple. Okay, so I'm not paying a lot for their growth because I'm expecting so much growth, right? And that's where these rules of thumb that the finance people start to break down. Because if you ever watch Mad Money with Jim Cramer, what he says is any company with a PEG below 1 is considered cheap because I'm basically getting $1 for less than $1. Okay, so therefore I like the PEGs that are less 1. But they could also be bad companies because they're performing poorly and therefore people don't value them highly. Any company with a PEG above 2, he says, is expensive because I have to pay a lot for that growth and I don't like paying a lot for that growth. But if it's a valuable company then of course it's going to be valued very high on its growth because it's making a lot on its growth. You're going to pay a high peg to invest in Facebook. You're going to pay a high peg to invest in Google. You're going to pay a high peg to invest in those fast-growing, very profitable companies. Right? It doesn't mean they're too expensive because maybe they're actually expensive for a reason, right? Or they could be overpriced. That's why when you do the multiple analysis, I like this additional level of granularity behind this analysis. Because one of the other things that we can pull from here is that Chipotle is also much more efficient than a McDonald's. Because margin times efficiency or productivity equals ROIC, so you're actually seeing the efficiency showing up in the multiples as well. Because with a low margin, high efficiency equals higher expected ROIC. The real challenge with Chipotle is the market's expecting them to spend a lot of money for that growth. So these aren't indicative of their long-term margins. These are indicative of all the money they're going to spend while they're growing and opening a lot of stores and doing marketing. That's why you're seeing a lower expected margin here, because we're blending the short and the long term. The long-term margin for Chipotle is probably a lot higher. And that's what's also distorting the PEG ratio, because people are expecting they're going to have to spend a lot to continue to grow and open up a lot of stores, because that's part of their strategy. McDonald's already has all the stores. They should be closing stores, not opening stores. They're in a different mode. Does that make sense to your analysis? So again, we'll do some more practice next week, but I really wanted to show you this illustration today, and then we'll talk about the other ones. Now, in the interest of time, I want to talk about your homework assignment real quick. So I have just uploaded a file called the Supertree. And you can use this as your base. So in the Supertree, this is the ROIC tree, which has the room for 6 companies. Right? Here's page 1 and the drill down. Here's part 2 and the drill down. Okay, so you can use this to start building out your tree. Tab number 3 is the cash flow. 6 companies, gross cash flow. 6 companies, free cash flow. 6 companies, reinvestment rate. 6 companies, dividend, share repurchase. Dollars, dollars, percentage, dollars. So, here's your assignment for Monday. For Monday, I only want you to do 3 companies. CVS, Walgreens, Rite Aid. I want you to fill out the Supertree for just those 3 companies. The average is the average of those 3 companies. You've already gotten the spreadsheets, so it's really more cutting and pasting. And all 3 tabs, including the cash flow tab. Right? Then I want you to do your industry analysis write-up. Okay? So fill out the Supertree worksheet for these 3, and then there's 3 companies, and then do the write-up, and that's what we're going to talk about Monday. What is the industry ROIC change, as opposed to one company's ROIC change? What is the industry cash flow analysis, as opposed to one company's cash flow analysis? That's the Supertree. That's your assignment for Monday. Questions? Okay. By the way, for your group projects, you'll have to fill out all 6 of your peers for this. So you do the same thing for your group projects with all 6 peers. So you can use this as well. That's the ROIC tree I want. That's the CFI analysis that I want in your final presentations. Have any other questions? Let me know. Otherwise, I'll post this video up to YouTube shortly.